Welcome to all of you. I'm glad that you joined us today. I hope you'll find this to be a very worthwhile webinar. My name is Rod Turner. I'm the CEO and founder of Manhattan Street Capital and the general partner of Manhattan Street Fund, which is a venture fund we're raising capital for as we speak. My background is that I started out as an engineer, and I've had the good fortune to move into entrepreneurship and startup companies in high tech. Prior to Manhattan Street Capital and the Manhattan Street Fund, I've done 6 other successful startup companies, all of them in tech. 2 of them we took public to the NASDAQ. One of those was Ashton Tate, for those of you who are a bit longer in the tooth like me. We went public in November of 1983. We became the leading database vendor with DBase on the microcomputer in that era. I was the vice president of sales there at the IPO. And then Symantec a few years later, where I was executive VP and general manager of chunks of the business. My team introduced the Norton antivirus, which essentially became Symantec while I was leading the group. That was a lot of fun. And 4 other successful startups with liquid outcomes for all involved, with positive liquid outcomes for all involved, and a couple of failures along the way too, of course. I launched Manhattan Street Capital almost exactly 6 years ago. In about 2 weeks' time, it'll be 6 years ago, in order to focus on Reg A+, because I felt then, as I do now, that Reg A+ is a tremendous fundraising instrument that can do good. It can really help great companies get funded that might not otherwise do so, or go public that might not otherwise be able to do so. So that was the focus from the beginning, and we branched out into doing selective Reg Ds as well. And now we're probably going to be adding Reg CF shortly. Anyway, that's what does Manhattan Street Capital do? We're a funding platform and advisory service that brings all the different service providers into place. And then on a selective basis, we only want to do offerings that we believe in, that will be successful and successful for the investors later. And we're consulting and advising and helping maximize success for all the companies that we bring to market, or that bring themselves to market with our assistance. The agenda for this session is the following. I'm going to cover these topics: misconceptions around valuation, review of what our objectives are for valuation, the big picture factors which drive it, the nature of investors in the different types of online fundraising tools we have available to us, the unique aspects of Reg A+, Reg D, Reg CF, and Rule 144A when it comes to valuation, reality checks on the valuation front, testing methods, then tips and techniques, and then I'll touch briefly on resources and handle the Q&A. So that's the agenda. Misconceptions. A lot of people I don't need to say it. I'll just say a popular misconception is that the SEC for example, in a Reg A+, that the SEC will only allow a certain valuation, but that the SEC doesn't judge the merits of valuation. They don't judge the merits of offerings. They judge the legitimacy of the entity and the security that's being offered, but they don't get into assessing how great a company this is, how worthwhile it is investing in. Okay, that's an absolutely important point to know. However, it's tempting to assume, and some people reasonably do, that the states don't care about valuation. And if you do a tier 1, which virtually nobody does in Reg A+ anymore, but if you do, then many of the states use merit review, where a bureaucrat working at the state level is judging whether he or she thinks that your company is a good investment, and valuation is presumably one of the things that they factor in. So they actually do care, and they'll often require audits as well, which is another reason why it's better to use tier 2 in Reg A+. Another popular thought is that you need to prove the merit of your valuation, that you have to have it documented in some way and evidence that it's a proper valuation. That is not the case. In some cases, that can be helpful, but it's certainly not a requirement in these offering methods that we're discussing. It's also tempting to assume that a professional valuation is accurate. And I've seen a bazillion, and some of them are great, and a lot of them are way the hell off the mark. It almost seems as though the thicker the document, the less likely it is to be accurate. But that, that's a lovely simplistic view, but that's the way it is with business plans. You get a 60-page business plan, it's almost certain the guys don't know what they're doing. But so there are great valuation professionals across the board. There are many. We have 4 or 5 that we deal with, but don't assume that that a valuation professional is going to get it right for you. There are many nuances to this, so many assumptions that have to be made to figure out valuation. I wouldn't personally depend on any single resource or any single source. And then there are another set of misconceptions, like our product's not done, so we can't raise money, or our product's not done, so we can't raise money at a decent valuation. And that isn't the case if the nature of the market that you're addressing is extremely exciting. And if the legitimacy of your effort and the strength of your team is solid, then you can command a decent valuation and raise sizable amounts of money anyway. Okay, this may be obvious, but what are our objectives in setting the valuation? Obviously, we want to appeal to investors, and we'll get into that a bit more later. We want to pass muster with the influencers out there, because one of the phenomena in online crowd capital raising or crowd investing is that influencers will kill an offering if they don't like it. I'm not saying they're malignant people. I'm just saying that somehow or other, when influencers don't like an offering for whatever reason, they don't generally do very well. They usually fall by the wayside. So I consider them an audience that we need to satisfy. We want another key criteria is that in some forms of online crowd investing, we're dealing with optimists, and we need to protect them against themselves, because they'll buy in at silly valuations and other terms that aren't really prudent, and they'll figure it all out later. So we don't want them to be unhappy later when they've got the smart advice they never sought out. We want them to be happy then, right? So we're trying to protect them from themselves. We also want to avoid a down round. There are no guarantees in life, yeah, but you don't want to set yourself up with such a high valuation that you will do a down round later, and the upset that causes. And obviously, we want to do a successful raise, but I'll get into that in a moment as well in some other nuances or some other aspects around it. So now moving on to what are the big picture factors that determine valuation or influence it. The size of the market obviously is critical. The stage of the business is critical. What's funny about that is it's easier to raise money. I'm not saying the valuation is appropriate. I'm just saying it's easier to raise money sometimes for a company that's pre-revenue than post-revenue, right? Because post-revenue is like, well, how much did you ship last week? What were the sales the week before? Suddenly you're into prove-it mode, while you have a lovely option, a lovely business model, and a killer market and a killer technology under development. You don't have to prove it yet, right? So it's life's easier. Those are different variables, obviously, than just valuation. What is the competitive landscape actually, right? It's easy to pretend that you're in a unique market and your segment is just yours, but will that really pass muster in the market? What's the reality? If you're actually in a market where your best hope is to achieve 8% market share, do something else. I mean, honestly, my advice would be do something else. But if you're raising money from smart investors, as I'll get into later, as is obvious, they don't want to back companies that are realistically only ever going to be a bit player. And the fact is that companies over time, this is one of those empirical facts. Companies that have less than 30% market share generally are going to have a really tough road to hoe, and those that have better than 30% market share are the ones to be in, as an investor and as an entrepreneur. So we need to have, that's a significant factor, obviously. And barriers to entry, there are nowadays, excuse me, because so many businesses these days online are dealing with consumers. There are many instances where the barrier to entry is we're going to kick ass, raise a lot of money, get the market, own it, build the brand. And that's our barrier because nobody else will easily knock us off. You could say that Apple has that down to a T. But in many instances, you know, it's great from an investment and valuation standpoint to have real barriers to entry, IP, patent protection, or other barriers to entry that make it hard to copy what you're doing, right? If it's a great idea and 3 or 4 other companies like it, are they going to be able to equal you fairly quickly? In which case, you know, that weakens the appeal, obviously. Strength of the team and the track record of the team is obvious. Momentum. There are companies that are doing boring things, but they're kicking ass with revenue momentum and profit growth, and they're exciting to raise money for and for investors to invest in because of the financial performance, right? And then we're in a whole different situation as to what the valuation can be. The majority of companies that are raising money in these forms aren't at that stage, but there are certainly some. We've got a couple we're working with right now. Momentum, but I would say, you know, you've got customer traction and you've got revenue momentum. Those are separate things. Customer traction, where you've got tremendous success and engagement from clients, and this is where the revenue bit maybe, you know, maybe you decide not to charge your early clients because you don't want to have to be in the prove it mode with revenues because they'll be so bloody tiny at this early stage in the game. You know, those are tactical methods that you might consider. But revenue, I mean, rapid growth in momentum, rapid traction, proof of traction, all of those things are obviously influences. It's almost so obvious I shouldn't say it. A less obvious one is when this company gets its business going, is the revenue going to be smooth or is it going to be inherently bumpy, right? If you're dealing with sophisticated investors, they care about that because it's harder to generate and support a high valuation over time in companies, public companies especially, obviously, that have bumpy returns. It's just much more difficult to sustain a high valuation. That's one of the reasons that software as a service, for example, valuations tend to be nicely high. Emotional appeal matters hugely in this online crowd investing thing that we're doing, of course, right? You can have a fantastic business, but if it's too difficult to explain or too boring, then you're probably not going to succeed at any valuation. It's not just about valuation, right? But that's a whole nother subject. I don't want to get into too much detail on that here. But emotional appeal makes it easier to justify a high valuation. Look at Tesla. That's an extreme case. I have these 2 terms I use, strategic and tactical. To me, a tactical company is a company that's doing something, and they may be doing it well. They may be very profitable. They might have decent profit growth. But when you look at what they're doing in the competitive landscape and the industry trends or the segment trends that they're a part of, you say to yourself, well, okay, this is a sort of a short-term thingy where I can make some money, maybe, probably, hopefully, but in the long run, where are they going to be? Is this going to be around even 20 years, 10 years from now? Yeah. To me, strategic companies are the ones that appeal and get the higher valuations when we're dealing with the more sophisticated investors, because the segment, the industry trends, the scale of the market is all there to be seen, and people will love that kind of company more, right? So obviously Tesla in the past, I was fortunate enough to be an investor in the venture fund, a venture fund that invested in Tesla in the beginning. Not that I've been smart about how I've dealt with my equity in Tesla since then. I've been utterly stupid, but let's set that aside and stick with the picture here. Okay, so strategic matters greatly, especially when we're dealing with savvy investors, and some of the investors we're dealing with online really are savvy. I want to digress into an important metric here. I was struggling where to put it, but this is cause for me to give you a big disclaimer that I didn't give earlier. It's a reminder to give you that. Please refer to the legal disclaimers in the comment section. about Manhattan Street Capital and what we do and things. We're not broker dealers, we're not underwriters, we're not securities attorneys, and we're not valuation professionals, okay? So what I am doing here on this valuation topic especially is giving you my observations, because I have a huge amount of relevant experience as to what works, what I see working. I'm giving you guidance and suggestions of tools to use. And in a minute, I'm going to give you a rule of thumb to use. But, you know, I'm not telling you what you should do. I'm not telling you what your valuation should be. That's not I'm not allowed to do that. I'm allowed to furnish you with information and guidance and tools, excuse me, observations, right? What I see working in the market. And that's what I'm doing here today. I don't want the regulators to be upset with what I'm covering here. Okay, so rule of thumb for me, you know, with those startups that I mentioned, I've had the good fortune to raise money from some of the best venture capitalists in Silicon Valley, not in the last 6 weeks, you know, but over time in the past. And I've done many investments alongside VCs and directly myself alongside other angel investors, a lot of that. And my experience is, as an entrepreneur doing on that side of the table and as the investor, that if you are doing a private round of that type, typically, it doesn't really matter. The company comes in with an expectation of valuation and how much money they want to raise. The VC will, or the investors will determine how much money they're willing to put in. It's cleanest and easiest to describe the dynamic with a VC, right? They will decide how much money they'll put in, and they'll decide what valuation they're going to go for. Obviously, if you've got a kick-ass, amazing company, or you're an exceptional, proven entrepreneur, the dynamics are different. But in most cases, you're going to get, if you raise enough money in this private mode to grow your company for 1.5 years, then the fact that you can get the money says this is viable, right? The question then is, what dilution will you experience, which determines the valuation. You're normally going to get 25 to 33% dilution for that 1.5 years of capital. That's a rule of thumb that has worked well for me, and I've observed and experienced. And so, you know, when you do successive rounds, you get successive dilution, and it can get a bit of a pain, right? But that's life. And capital enables you to do a lot of neat things. So it's not a bad thing as long as the VCs are great. In my experience of observing Reg A plus very closely, legitimate offerings that succeed in raising money will typically experience half that dilution for the same amount of capital raised. That's a rule of thumb I want to give you to use just as that, as sort of a checkpoint thing to use. Don't use it and say, oh, well, Rod told me that must be, it's great, because I'm not approved to suggest it in that manner. But it's a public offering, Reg A plus, right? So that makes the dynamics different. You've got there's other nuances I'll get into later, but that's a rule of thumb I've seen in private Reg D transactions, and I see it working in a similar manner in the way I just described with Reg CF and Reg A plus as being. The thing you need to avoid with using this as a guide is that it's too easy, especially in Reg A plus, right? It's too easy to be in a situation where you need 12 million. That's what it really takes. If you were raising money and getting heinous dilution from it, from a VC source, there's no way you'd take more than 12 million, but you don't want less because that's what you need, right? So the trouble in Reg A plus is you're allowed to raise 75 million in a year. And if the marketing and everything else is kicking ass and you're raising the money successfully, woohoo, let's go ahead and raise a lot more money. In that instance, please don't at the beginning of the offering say to yourself, well, it's not 12 then, let's get 75 and let's use that percentage, because that's silly numbers then, right? You need to stick with if you're using this as a guide, use it with the amount of capital you would raise, and if it was difficultly dilutive, if you see what I'm trying to say there with bad English. Difficultly, that's not even a word. Okay, moving on. The nature of investors in these online offerings. It's amazing. It's really cool in Reg A plus, and the same in Reg CF. But obviously, we have more experience, and I have more experience with Reg A plus. The investors are optimists. We've had situations where when people come to an offering page on Manhattan Street Capital from the advertising outreach, we're tracking all of this, of course. when they arrive, in order to see the investment page, they have to give us their email in order to do so. So that they then become a prospect that the company markets to with our assistance. So we track the cost of getting those emails, obviously, and we track the conversion of those emails into investors over time. Well, we've had it happen where 7 out of 10 of the people who gave us their email invested on the same visit, in one visit, right? So you know when that's happening, obviously it's a good offering, obviously it's been well marketed, but the nature of the investors are that they're optimists. There's no way in hell that would happen unless they were optimists, right? They are not scouring the earth trying to find reasons why this is a bad idea. They're not doing hours and hours of due diligence. They're not putting a skeptical hat on like a Reg D investor would do. So another couple of interesting dynamics there. 60% of the investments typically come in via a smartphone. Same thing, right? If you're doing it that way, you're not quite able to see as much detail. You've got to be an optimist, right? That's another aspect of it. This is all relatively new stuff. 2 years ago, that wasn't the case. Yeah, so that's a big characteristic about Reg A plus and Reg CF, is that we're dealing with optimists, and if they like it emotionally, and if they want in because they see it as a strong upside, or if either one of those is strong enough, and ideally if they're both strong together, then it's easy to raise money from them and becomes much more cost effective, where they're investing quickly and easily in the way I described. But we've got to protect them from a deal that they'll later be pissed off about, right? Because they're obviously too optimistic to check that kind of thing. True story. And there may be other nuances about the offering, which should be, even though they aren't required typically, they should anyway be prominently displayed on the offering page to prevent those folks misleading themselves and not knowing some of the more salient points that they should know, right? So that's the stuff that matters there. Pardon me for branching out of out of the valuation front for a moment there. Reg D is a whole different puppy, right? Because accredited investors have so many options before them of places to invest. And they've probably got burned a few times like I have. I can't believe how many stupid investments I've made over the years. Thankfully, I've had some incredibly successful ones that give me permission to let myself off the hook for the stupid ones. But you learn, right? You get more skeptical, you learn what to look for, you test out things more. Reg D investors have these two characteristics sort of at a very summary view. They do care about valuation. They really care about that. They're looking at this and saying, well, is it? I don't know. They're not going to go for a deal if they're iffy on valuation. Another aspect is, to my mind, in online raising, because it's harder with Reg D, to even get their attention is harder, to get them to invest is harder. It's got to be a no-brainer. It's got to be so exciting a deal, so exciting an opportunity, they don't tell their friends because they're worried the space will be taken by their buddies. That's a test I use. If it's that good, that's what we want to be doing. That's the deal we want to be offering, because that's the one where people will invest and will have a success in Reg D, with Reg S as the international partner to it. And then Rule 144A is a different puppy again, some obvious aspects of it, but I've got to briefly tell you what it is. Most of you probably aren't that aware of Rule 144A. To me, it's come into its own right about now. In the last 6 months, it's become a smart thing to do. So essentially, you partner it with a Reg S offshore, anyone can invest offshore. In the US, only institutions can invest. The good news for the institutions, well, the reasons why, and obviously this only works for companies that appeal to such institutions, right? So we test that, or we know it one way or the other. We have to be high confidence that that's the case. We have 3 companies right now we're in discussions with. We only started discussing and promoting the idea of doing 144A recently. But anyway, point is, obviously it's got to be appealing to institutions, but what appeals to them right now is interesting and different, because there was a modification made about 3 years ago to Rule 144A, allowing it to be marketed online to anyone, although only institutions can invest. So that makes it feasible, like Reg D 506C, to market it online. Secondly, there is so much money floating about in the hands mostly of institutions, and they don't want to just do the obvious. They want alternative investments, right? We as a collective here, my company, my platform, you guys, all of us here, we are a source, in many cases, of very attractive companies that are alternative investments with different stories attached, right? So when the quality is there for a cynical bastard to look at it and say, yes, I like this, strategic enough for me, passes muster, then those guys are going to get in. And another advantage to those institutions of these offerings is that they are immediately liquid to other institutions. They're able to sell their holdings to other institutions immediately upon acquisition. And so for the issuer company, you'll be able to list your company on an alternative trading system, which can only sell those which essentially facilitates institutions to buy and sell during the first year, and then they can sell to anyone. But in the first year, they're immediately liquid, and it's a listed company, and the upfront effort in a Rule 144 is the same as a Reg D. It's beautiful. It's really straightforward. The disclosures and so forth are very, very easy. So it's a public offering of a type, and it fits the fact, the third leg on the stool, if you will, for why it matters now, is that during COVID, it seems to me by evidence that institutions are engaging. We're seeing so much more institutional interest and investment in online raises that we didn't see before. Why? Because they've all been stuck at home, right? Sitting on their hands, COVID. This is courtesy of COVID. Those three developments make 144A interesting in my book. So valuation wise, it's not, the obvious side is, institutions are skeptical. They have their own processes. They care greatly about valuation, but they're also opportunistic, looking for places to put this money. They've got a lot of low cost money that they want to deploy intelligently in alternative investments. So they may not be quite as hard to please on the valuation front as a Reg D typical investor would be, frankly, because they've got a lot of money they want to deploy. And that as long as it's sitting in their accounts earning nothing, they're not very happy with that. Okay, so now moving on to unique aspects of these offering methods. I've covered some of these already, but I will attempt to do it. It's not attempt. I'll hit on the bits I haven't hit on. I'll cover those parts here. So Reg A Plus, it's a public offering which supports a higher valuation. You get higher valuations, I already explained that. If you're dealing with optimists in the main, I mentioned that too. You are allowed to change the valuation in a Reg A Plus as you go, up or down, 20% cumulative by telling the SEC you're making that change and doing it right away. That is to say, not asking if you may, just actually doing it. You can do it in one or more steps. And if you want to exceed 20%, then you need to request that of the SEC. But that, if you change nothing else, that's a 2 or 3 week pause to the raise whilst you go to the SEC and they qualify that change, because they are not judging the merits of the case, right? As long as you only change the valuation and nothing else, it's a 2 or 3 week turnaround to do that. Even if it's a 2x valuation step up, because there's been a substantial step up in the value of the business because something big happened, right? That's a legitimate and very valuable aspect of Reg A Plus in my book. And there's another effect that I hadn't thought of in the early days, which is the endorsement effect of having your company qualified by the SEC. It works wonders in certain places, right? Strategic partnerships, various situations, institutional interest, because you've been qualified. There's, a very small subset of companies have had that level of rigor that they've had to pass through. Reg CF, it's very difficult to change price in a Reg CF. Up until now, a large proportion of Reg CFs have been done through convertible notes. Personally, I don't like investing in convertible notes unless they're really pinned down as to what the specifics are, because I don't want the uncertainty. But I think now with CF going to 5 million, far more of these deals will be set at a valuation, you're buying securities, not buying a convertible note. The valuation metrics and thoughts that I gave you earlier apply equally to CF as they do to A+, in my opinion. It's a convertible, it's a private offering, so you don't get the boost in valuation that you get with an A+. So actually, what I just said isn't true. You can't command the same valuation in a CF as you can in a Reg A+, because it is actually private. But other than that, it's very similar. The main issue being that you're dealing with optimists and you need to protect them from doing things they wish they hadn't done later on. Okay, Reg D is predictable in the sense that I mentioned earlier, we're dealing with cynical investors, very much from Missouri. They need to see the proof, and it needs to be a no-brainer. I already said that. The important difference is that you can easily change the valuation in a Reg D, very, very easily. It's far easier than in a Reg A+. In a Reg A+, there are serious restrictions that we understand and know how to work with the securities attorneys and what the SEC expects. The flexibility in a Reg D is immense because the SEC, as well as in Rule 144A, the SEC says these are sophisticated investors. You know, they don't need to be protected the same way that Reg A+ investors do. Excuse me, wrong way, moved in the wrong sequence. So Rule 144A, I said this strategic, covered a lot of that. Yeah, it's a public offering, and they are cynical, but they've also got a lot of money burning holes in their pockets at the moment. And that's, you know, clearly a temporary phenomenon, but you know, how temporary, right? Is it 6 months, 6 weeks, a year, 2 years? We don't know. And in the meantime, you know, they're in that situation, and we can help them out by giving them great companies to invest in. Okay, moving on to reality checks. Most of this is probably really obvious, but you know, it's more about how you apply them, I think. And I'll get into testing in a minute because I think that's the most useful one. Comparables, yeah, go and look for companies that are similar if they exist. Obviously, if the further along your company is, the more likely you can go check out the valuations of public companies and get some learning from them. You could obviously revenue multiple, earnings multiples are valuable. You know, you just use them as a rule of thumb to give you a sense if you have revenues and earnings. And net present value, you know, the trouble with predictions like net present value is, what is it? It's a series of assumptions, you know, which can be completely out to lunch, and doing a net present value on that future revenue and profit prediction, given the nature of many plans that I see, is going to give you a ridiculously high valuation. So, you know, I wouldn't generally spend too much time using net present value as a reliable method of setting a value. But in the right hand, it's a good tool. Okay, testing. So this is, you know, depending on the nature of the offering, this is either, you know, this can be really important. Rule 144A, I consider it really important. It's not enough to say, yeah, we think this is institutional grade. That's not enough, right? So then you're left with, how do we test that? Well, these are the methods of testing that I recommend that you use. And this is general. This is going to apply more or less depending on the nature of your company and which offering method you are planning. But if you can get into VCs and get exposed to them, asking them is useful. Quite often they're pleased to advise because they want to sort of know what's going on. They want to be in touch. Not to say that they'll invest, but they're interested in new companies that are coming along. And approaching them and asking for advice is far better than asking them to invest anyway, because they're more open to that. If you have friends who are, you know, in the biz, entrepreneurs and CEOs, ask them. A very good method is to go onto LinkedIn and engage with target investors and ask them. I mean, essentially approach them and say, look, in a very candid manner, I'd like to get your sense of what you think a fair valuation for my company is. It's shocking how helpful people are when you're very direct and candid like that. If it's in the case of family offices, same thing applies. If it's a Rule 144A and you're testing out institutional appeal, engaging with appropriate level family offices and other institutions is a smart move. Some of them will engage, connect with them first via LinkedIn. Some of them will engage and then get in a dialogue, hopefully in a Zoom call where you pitch the company for 10 minutes and ask their advice for 10 minutes. And you come away a lot more knowledgeable about what they're up for, right? Do they like the company and their sensitivity to valuation? And by the way, it may end up being a real prospect. So this is worth doing stuff. And then the last one that I like the best, because it tests the marketing side too, is this, because you can have conversations with people and convince them that your company is amazing. That is not the same as marketing it online, if that's what you're doing, right? Most of us, I think, here are planning to do an online raise, in which case it's a whole different puppy. We're going through a porthole, which is, it's got to be easy to convey online in advertising, right? It's got to be succinct and easy to explain it. And when they arrive on the offering page, it has to be easily explained and engaging there. So that's a much smaller selection of companies that fit that model. Anyway, a market test the water style is a really good thing to do, especially when you're doing what Run 44A. And you know, if it's an iffy deal, you know, when we have companies approach us and I'm concerned, you know, if I'm worried that it won't work, my advice to them is either don't do it or do a test, because I sure as hell don't want to waste everyone's time and money going live with an offering that's iffy. You know, let's not do that. Sometimes you can change the nature of the offering to one where it's really engaging, but usually it's a matter of the inherent appeal and ease of communication, right? So let's test that. That's the smart move in my book. So then what are you doing? You're putting up an offering on a simple template that's easy to put together. And you are advertising through Facebook, Instagram, because they're the best tools for this, and figuring out basically how much it costs to get engagement and adjusting as needed for a while. And, you know, in 2 months from beginning to end, you've done a real test. And by the way, you can, if you're working with us, we'll ask for their emails and their phone numbers so that you can call them up, right? Text them first, because no one picks up anymore because there's so much spam. But hey, I'm the CEO and you looked at my offering. Would you mind taking a call from me? A lot of people will love to have that conversation. And when you have that conversation, you will learn so much. And it's not, you know, a survey that's going to work terribly. It's a qualitative conversation where you discuss the company, you hear what they are thinking, you learn, right? And of course you're selling. That's another advantage. But to me, that's the best way to go, right? That is the best way to do it. When we do that, we've made a couple of proposals recently, you know, $7,000 to $10,000, $12,000, depending how many offerings we're making. Because if we're making a debt offering and test versus an equity test simultaneously, that makes it more complex. But that's an all-in cost range to be thinking of if you are working with us. And this webinar isn't to sell you on us, even though it is. it's really to provide help. It's all of the above, isn't it? Okay, so then calling the prospects, though, whatever it is, whatever method by which you are connecting with people, having conversations with them is a phenomenally valuable thing, and adjusting what you ask according to the flow of the discussion is such a useful method. Okay, tips and techniques. I mentioned this earlier, actually. It's so much easier to raise money for a pre-revenue company, you know, so don't casually start taking revenue. Think about that, right? Because the minute you get it, then you're being measured, and being measured is, you know, a whole nother challenge. Debt offerings can be interesting, right? You know, if you're really confused on valuation, or if you feel like currently the valuation is just not going to cut it the way you want, you don't want that dilution. If your company is solid enough that you can carry a debt offering and the interest burden that goes with it, consider that. And if you make a large enough reserve from the invested principal to pay the dividend for a long enough period, and thoroughly disclose that you're doing that so that it's all completely above board, that's another way to go. There are a large number of people out there looking for decent returns on their money. I don't see this as an overall panacea, but if the company is strong enough, then sometimes that works. And it obviously involves no dilution at all, unless you're offering equity with a dividend payment. An important point is that if your company isn't the right nature to market online or successfully. Lowering the valuation will not fix the problem, right? It's not valuation sensitive. If you can't get people in and engaging who aren't even initially looking at the damn valuation, changing the valuation isn't going to do anything for you at all. So don't depend on that as a solution, right? Different story if you're dealing with investors one-on-one, because you actually have their attention and you can explain it, but it isn't going to work in an online raise. We talked about how it works with VCs and I gave you suggestions as to how to use that. I think my suggestion on Reg CF is mostly to be careful with it, because it's not liquid. You're dealing with enthusiasts, so you've got some shades of Reg A plus there and some shades of an illiquid offering, right? So don't shoot for as high a valuation in it as you can carry in a Reg A plus, and don't go for excessive valuations anyway. There are some, but not many, there are some instances of companies that have done successive Reg A pluses where, not many, but there are, a couple where they've got to be really ridiculously high valuations now. And I look at them and I consider them a skeleton in the closet for the industry, for Reg A plus, because unless they're insanely lucky and turn into a Tesla sort of company, that's going to come back to haunt them, So I guess that's an obvious thing to watch out for in Reg A plus, especially because you can convince investors to invest at higher valuations than they really should. So let's not do that, because that's going to cause problems down the road. Keeping it simple and being flexible. I do meet entrepreneurs that are rigid about dilution, and too much rigidity usually isn't going to work in your favor. Flexibility is the prudent way to go. Resources to use, obviously underwriters, they can tell you what the valuation should be. They're allowed to. Valuation professionals, they're supposed to, and they're allowed to, right? Go there. We have 4 or 5 valuation professionals that we're in touch with that we can refer you to. I think one in our resources on the Manhattan Streets Capital page, you can click on resources and there's a company there with a low cost valuation system that's based in software. This completes the presentation. I'm going to move in a moment to Q&A. I have one announcement I want to make, which is that our SPAC Matchmaker forum will be going live next week. We're not going to be blitzing marketing it initially. It's sort of in beta mode next week. So if you want to be in it and check it out and start using it, use the emails that you experienced, that we sent you here. Just reply to them and say, hey, count me in for SPAC, and when we're live and ready, we'll send you an email and give you a direct invitation to it. So that's the commercial. We've got that bit done. So now let's go to Q&A. I will see what we have going here. Bear with me while I have a gulp of water. Or a glass, actually. Wow, a lot of text there, but that's all the legal mumbo jumbo. Please do read the disclaimers. That matters greatly. We exist in a regulated space. Yeah, framework, Ashton Tate. It was a good product, and neither framework or Symphony really had a big enough need to survive, frankly. That's the bottom line. They were both kind of a nice idea that didn't cut it at that time. Some of you will have interest in my book. Somebody promoting a book. Well, there you go. I'll move on down. That is not a question. Why would a boring presentation harm valuation? Well, I didn't say that, I don't think, but it's more about, frankly, valuation isn't tied to the quality of the presentation. If you can convey excitement in your company through the offering effectively, and if you can advertise it effectively online, there's certain companies that fit that model and others that don't. It's really about if your company doesn't fit that model, then online crowd investing probably won't work. That's the main issue. Given what I teach, I don't consider myself teaching. I'm presenting options, but still, given what I'm saying about valuation, why would any investment bank price an IPO such that over half the post-listing value is left on the table? Yeah, I am not an expert on those companies, so I'm not going to comment beyond that. Essentially, there are methods that are used to value companies, and when companies go public, there are good logic used. The valuations that they go public at are usually a little lower than the market will sustain for obvious reasons. And I'm absolutely not suggesting anything that contradicts anything which is being done successfully with IPOs every day. I'm talking about crowd investing online, which can lead to an IPO and a Reg A plus. Given the IPO listing price errors this year, isn't there a better remuneration contract to give an investment bank in order to maximize founder receipts than a 7% flat rate? Well, yeah, in the long run, what's going to happen is that you won't need as much engagement from underwriters. It'll be an online event, right? Over time. I mean, I'm not suggesting this is going to happen next Thursday, but over a period of time, people won't be needing full-on underwriter support and they won't be paying for it. Therefore, you can do direct listings now. What price would your rules place on Snowflake Airbnb? I'm sorry, I don't have the ability to on the fly price it. And I'm not suggesting, I'm not arrogant enough to suggest that I would have a better solution for what those companies should be valued at. I absolutely don't. I don't think I know more than those folks. I don't have any knowledge about, well, how well or how badly they're priced. So I'm sorry, I can't comment on that. Why do I hear from investors, CPAs, and attorneys that serve the VC community that VCs and angels don't like to follow after CF and Reg A plus? Too high valuations make their model work or other constraints? Yes. So it's two things, right? Companies doing CF and Reg A plus do get higher valuations, which makes it less attractive for the VCs to come in because the company doesn't want to do a down round or they want to do a bigger step up this next go round. That's a serious reality that is shifting around. It's changing the universe for venture capital firms, and they'll have to learn to adapt to that. But when it's a kick-ass amazing company, they aren't going to care that there are too many investors, for example. There are ways to fix that by convincing the investors to go into a single instrument. But realistically, if the VC loves the company, how many investors, their most common complaint is valuation and too many investors, right? But what do they want to do anyway later? They want to go public with these companies with lots of investors. It's really a red herring. They're not going to protest if they love the company, you know? They're really not. They're going to find a solution. Somebody offering their valuation ideas. If you do a reverse merger to go public, what haircut do you have to take versus conventional IPO? I don't know the answer to that. It's really going to depend on the specifics because each reverse merger is a different puppy, and it's all about the appeal of the company anyway, and the deal that was struck buying that reverse merger. Yeah. Okay, lots of comments, sort of commenting on the comments. You can adjust the valuation of a Reg A plus up to 20% up or down after launching, yes, without requiring SEC approvals, correct. It's a notification. You notify the SEC through EDGAR, and from the point in time that you have notified them, you have 48 hours in which to go effective with that change. It's a notification. You cannot, make weekly price updates and things of that ilk. They don't allow, there's wording for it that's proper. They don't allow you just to go willy-nilly and do it. But in terms of the change itself, that is the mechanism. What are the criteria for a biotech pre-revenue company to launch a Reg A plus? Yeah, biotechs and real estate are the biggest segments of opportunity. Well, basically they are. Biotechs often are phenomenal. If they appeal to consumers, if the consumers understand what the biotech is addressing, then gaining their investment interest is very easy. They understand, and we make sure they understand, that if this was FDA approved, it wouldn't be here, right? We're preclinical typically. We're raising money based on the promise of future upside, financial return, and doing something really worthwhile. Yeah, if you're addressing an obtuse disease nobody knows, it's a harder battle. But when you're addressing something that people care about and know about, then it's a much, much more straightforward thing. So it's the credibility of the team, size of the need, and the awareness of the need. Obviously, all the normal things from a due diligence standpoint, but being able to explain it and having it be something that people care about is the most important aspect about raising money. And no, you don't have to be 6 months or a year away from revenue or FDA approval. Angels seem to ask for a cap on convertible notes. Well, I'm an angel investor. I'm not doing much of it now. The reason I will virtually never do a convertible note without a cap is because it's so easy to get ripped off, right? If circumstances are such that the company never actually needs to raise money until way the hell later and then raises it at an obscene valuation, and you get, a 20% discount on it, that is really screwing you, isn't it? Because you were there at the beginning taking a risk. So I don't want to do that. That's my perspective. Other people may have different ones. What are the criteria for a biotech? How are we doing on time? We're okay. For a biotech pre-rev, oh, I already covered that. Attractive yield in Rule 144A. We are learning more as we go in 144A. In Reg A plus, it's 8 to 10% is what I see, maybe a bit higher, depending on the nature of the company, is what I see working in the market. Institutions, you're talking a high caliber company to have institutional appeal. Maybe it'll be high credit rated, and then it can be a lower return, right? Reg A plus allows up to 75 million. It's comparable with a small IPO. Understand in most IPOs, the underwriters want the company to be majority owned by crossover investors before they take you to go IPO. So realistically, what happens in a Reg A plus IPO, really a small IPO of any kind at the moment, is that the underwriters want you to go raise the money like you just said. So what do? We raise the money online first, right? We get it to the point that we raised enough money and we got enough investors too, that then we approach the underwriters and say, okay, it's all here on a silver platter, ready to go. It's a kick-ass company. We already talked about it. Now we're ready to do a deal. You get a better deal, and they'll kick into gear and engage because we raised enough capital, got enough investors already via online means. Yeah, that's the sequence to use in the situation you're describing, which is a really good sequence in Reg A plus. Relatively speaking, what's more important to the success of a public offering? Marketing or valuation? Well, without marketing, nothing's going to happen. It's like having a party and 3 people show up, right? It's all about marketing, success, cost-effective engagement with marketing, which is a huge thing we focus on, obviously. Valuation matters, right? But it's not the driving factor in a Reg A plus for the investors as much as it should be, right? But so what's more important to a public offering is marketing. And of course, if you're going to do a deal and, like we were just discussing, raise money online at an excessive valuation and then bring it to the underwriter and they can't take it out public at that valuation, you can do it. You can, fix that, but that's not what you want to do. That's a mess, right? You want to have spoken to the underwriter on the way to make sure they buy into the valuation that is being offered, so that they're happy when you list the company, because they'll use their syndicate to wrap it up and raise a bit more money, enough to make it interesting for them. Yeah. VC valuation model produced big sensitivity to multiples. There's so many variables involved, there are many different models. I don't think that any one model is uniquely useful, especially really in any case. I mean, the situations can vary so much. Let me give you an example. A company approached us that was doing 40 million plus in revenues, and they were modestly profitable with a slow growth rate. And they were insistent on going public on the NASDAQ, right? There's no way in hell. I mean, that company was boring, hard to explain. What they did wasn't interesting, and their metrics were awful. There's no way they could go public. It was a silly idea. They could have done a reverse merger and then they'd be a moribund public company. But these things are obvious though, right? You know, if it's got dynamics associated with it, then it's attractive. If it doesn't, it isn't. Shorting against Reg A plus offerings. I assume you mean recently public Reg A plus offerings. Any Reg A plus IPO that lists on the NASDAQ, NYSE, or on the OTC markets is like any public company in those markets, subject to naked shorting by brokers. The SEC doesn't limit them to having borrowed be able to do shorts. I wish the SEC would change it, but they don't ask me my advice on these things. So there are many companies that we talk with where my advice to them isn't to go list unless they are really ready for the rigors of the announcements they need to make and the momentum they need to have and the seriously conservative predictions they need to make to the financial analysts and so forth. It's a seriously big challenge to go public and maintain a great share price, essentially to deflect the attention of the brokers that want to put shorts on things to something else, because your company is doing such a good job of making announcements that are material and showing good results and setting conservative expectations and beating them. The alternative solution that I like in some cases is to list the Reg A plus shares or securities on an alternative trading system, an ATS, because there's no shorting, there's no naked shorting. So now you're just giving liquidity to your investors in a simple manner that does not expose you to having to spend half your life defending the share price or, you know, thereabouts, right? Yep. Please comment on same question duplicated. What's a typical return on investment found to be attractive to investors? Yeah, you asked, I mentioned that earlier, which is 8 to 10%, sometimes higher, depending on the nature of the offering as a payment of interest. Can we coordinate a reverse merger with a public shell and do a Reg A plus at the same time? I don't think so. I don't think the SEC will allow that. Can a new public company via reverse merger with a public shell offer a Reg A plus afterwards? Yes. You can do a secondary offering with Reg A plus for any legitimate entity, reporting or non-reporting, if it's a public company. I understand there's no certain way for or formula to get a valuation, but how can I have a big picture about the valuation of my company and myself before I go further? I would start off, you know, the problem is this: if you need, I said 12 million earlier, let's use that again. If you need 12 million and you go and approach some potential investors and they are not in the least interested, then valuation is a secondary issue, right? You can't raise the money. But if you get engagement and interest from them, then you know, hey, I could raise 12 million. And then I would suggest to you that's enough to know that generally you're going to get 25 to 33% dilution in that Reg D private transaction. And you can use that information as a guide, yeah, as to where to go next. I'm happy, I can't take too many inquiries about this, but I'm happy to handle queries about this subject after this webinar if you want to email me. I'm not a valuation professional. I'm not allowed to tell you what it should be, but I'm giving you this guidance to be of help, obviously, and I can do that afterwards too. So, I've given you the best practices that I can already in this discussion. And this will be in a recording, so you can refer to it later. How long to complete the process of a Reg A plus? So essentially when you sign up, assuming a simple audit, right? Because you've got to have if the company's been around for 2 years, you need 2 years of US GAAP audits. So in a company that's got messy financials, that slows things down. But if you don't have complex financials, then 4 or 5 months to get live and be raising money. About 150K up front, could be slightly less, could be significantly more, depending on different issues and aspects, but use that as kind of the low end of the range of cost of all the expenses incurred prior to raising money, not just some of them, all of the costs. At 4 or 5 months is realistic. Thank you for that compliment. And then you're raising money and you've got a year to raise the money. And you got to know this: if you're raising money, any sizable sum, you're raising 20 million, 30 million, this is not going to happen in 3 weeks, right? Don't kid yourself into thinking that because we've got permission and we can market it, that it's all going to happen overnight, unless you have a large customer base, in which case the marketing expense is trivial. We're emailing these fans and customers and they'll invest and we're all done. Right? The best example of that is VidAngel raised $10 million in 12 days live to investors with a break in the middle to fix some stuff, because they had a large happy customer base of 30,000 people, most active customers that they emailed, right? I haven't seen one since that easy, but there will be some. We've got one company coming through our system that has a very large fan base, so I'm looking forward to that. But realistically, when you're raising money online, it's a journey, right? The average investment amount increases with time. Your credibility in the raise increases with time. Being impatient costs a lot, The best advertising conversion rate to dollars invested that we've achieved so far, that is to say the agency achieved with our guidance and challenging them, is $3.30 spent per $100 raised. That's the best we've done for a biotech. And more recently, we've done one, we've experienced $6.50 per $100 invested in a relatively early raise. So I'm pleased with that, because that promises more potential further down as you tweak and adjust further. Point being, though, once, one of the issues with Facebook, Instagram being that they're the most effective source of buyers, investors, is that they jack up the price. When you start spending megabucks to raise megabucks too fast, you reduce efficiency. Okay, so figuring out how to handle that and manage that is one of the proprietary things that we do that we won't disclose, because we don't want everyone and their brother to replicate that method and cause Facebook to turn it off. But the point is the same, which is realistically, if it's a large raise, give yourself a year. Don't expect it to be done in 3 or 4 months. The first 2 months are testing and tuning and stepping up spending and adjusting as you go. Yes, existing shareholders can sell up to 30% of the offering in a Reg A plus. How do the Biden changes make you change an offering? I don't know what the results will be. I don't see it making any material difference. We've got enough on our plate, making sure we're doing offerings for companies that fit, with that appeal, and then marketing the hell out of them really efficiently. There are so many other complications that aren't worth thinking about to me, because they're so secondary. Pardon me if I'm oversimplifying it, but that's my perspective. What I do think is going to change with Biden presidency is that, there'll be companies that will raise money that couldn't before, because institutions and others will be following the lead of doing environmental spending, right? There'll be giant institutions where they decide 10% of assets will be invested, or some number, 20% of assets will be invested in environmentally conscious things, right? So having those companies in our portfolio of companies that we bring to market, those companies there's a lot of money there, right? That's what's going to happen. It is a fairly new development, or completely new. Tell us about companies you tried and spent and failed raising meaningful amounts. No, I don't want to do that. Christ, I focus on the positive, guys. But we've had failures and others have had failures. What I would say to try and be useful is that the biggest cause, actually, I'll give you some percentages for a moment. 60% of the companies that start a Reg A plus filing with the SEC complete it and get qualified. In my view, most of those that fall by the wayside didn't realize how hard it was, and they fall by the wayside along the way. The SEC never says no, they just ask questions, right? And when the questions are hard to answer, then you say, oh, you know, oh, this isn't quite as fun as we thought it would be. So that's one key statistic, and a couple others. Reg A plus as a category, a bit more than $1 billion was raised in 2019. The early estimates that we've made are that about $2.5 billion was raised via Reg A plus in 2020. And in my view, it's going to be another 40% up in 2021 based on what we're seeing. So it's becoming real, right? The whole private placement space is about $1 billion a year. The whole VC industry is about $90 billion a year. The whole IPO industry generally, not today with so many SPACs, generally is, you know, like 160 billion a year. The SPAC thing has really changed that temporarily, but you know, in the scheme of things, it's still tiny relative to where it will be. But what causes failures in Reg A plus the most is companies going live that didn't realize they were preordained to fail, because what they do can't be marketed successfully online. Or they did things like set a very high minimum investment amount, other things that they're just silly, but they didn't know any better. Things like that get in the way, or they don't have any decent marketing applied. They get somebody into market who doesn't know what they're doing. There's a lot of opportunities to screw up. Just because you've got the right to do a Reg A plus, it doesn't mean, you know, that it's a foregone conclusion you're going to win by any stretch. There's a lot to doing it right. Can a SPAC use Reg A plus to raise capital as a blank check company? We have a whole webinar dedicated to that subject. And the answer is, in essence, in real estate, yes. In non-real estate, not exactly. So to go public to the NASDAQ via Reg A plus, you have to have 2 years of operating history. And there are different ways to get that, right? Have it already in your business or buy a company that has it, even if it's a small private company. But it has to be actual activity. It can't be that the bank accounts existed, the entity existed, you know, it's got to be actual activity. But the bigger issue is that to use Reg A plus to raise money for an acquisition company, you must have a business focus that exists before you bought a damn thing, okay? So, for example, if I was doing a SPAC and capitalizing it by Reg A plus, I would build AI machine learning software at the beginning. I would have that be the focus of the technology side of the business, which would give us a license to raise money, if you will, give us the process by which to get approval from the SEC. They're happy to have you do acquisitions. It's just it can't be a blank check company, right? But what I would do is that I would do AI machine learning, and I would plan to benefit every acquisition we made by applying that technology, because there's so much amazing stuff you can actually do with it. Right? I mean, that's a genuine thing I would do if I had the time, which I absolutely don't. But hopefully that framed it for you there. Yeah, thank you for putting that up. Akash put the link to that SPAC webinar in the chat box. You're welcome to get it there. Okay, and then can a pre-IPO convertible note convert into a public offering at a discount to? Yes, good question. Yes, you can do that. So it took a long time to get a securities attorney to buy into the possibility of this. I was pushing for a while, but essentially, because the challenge was that you can't guarantee the SEC will ever qualify your company, right? Reg D is different. You can say convertible note goes into our Reg D. It's not iffy whether you're going to have the Reg D in the future. It is iffy if you're going to have an investor, different story. But in Reg A plus, because the SEC is who they are, they're not going to allow you to have a convertible note where the only outcome is that the money invests in the Reg A plus, because it might not get qualified by the SEC. So you have other exit clauses. But the way it works and what makes it attractive is that you determine the discount that those investors get from the Reg A plus initial price. And then when the offering opens, their investment converts into an investment in the Reg A plus, which is immediately liquid as far as the SEC is concerned, no matter when it was purchased, right? The holding period is history because it's an investment in a Reg A plus, and they are liquid as far as the SEC is concerned. So if you gave somebody 4 months before the Reg A plus a 50% discount because they're taking a risk, right? The offering hasn't happened. It's a legitimate risk. Legitimate discount doesn't, whatever. If you give them a 50% discount, then when they invest, they get a step up in value of 50 from half to the full, 50% step up, right? Well, it's actually a little bit better, isn't it? You know what I mean? They put in a $2, it gets converted to $4. So they are then a part of the offering. So you have initial traction in terms of window dressing. You've already got money that's in the Reg A plus. That can be a problem if it's too much money and it takes you over the top, but that isn't generally going to happen. So hopefully I conveyed that succinctly and effectively there. I consider that to be a very useful way to go as an attractive incentive for investors to invest early and help make the Reg A plus happen, right? Thank you for the positive feedback. Well, that looks like all the questions are asked and answered. So if you have any more, send them now. Otherwise, most SPAC are newly founded companies less than a year. So they have, yes, that's true. If we use a SPAC with some specific requirements and Reg A plus, it is quicker to get money from institutional investors and private investors in a SPAC-like company and merge the SPAC to our own company. Yes, that can be done. That can be done. Yeah. So the point there is, if you need 2 years of operating history and you don't have it, in order to use Reg A plus, you've got to buy something that has it or merge with something that has it. Right? That's in a nutshell. Those are the two hurdles. You know, I don't think the SEC would be too enthusiastic about you calling it a SPAC, but that's up to them and their individual examiners, because it isn't a SPAC, right? You've got to have a business focus. And you've got that is beyond just acquisitions. If you're starting out with an empty company, as it were, if you start out with a company, let's say you buy a company, for a private company with some operating history, with a could be a very modest dilution, it has business, right? If that business is what you want to continue, then you are able to raise money for that business, and the fact that you plan to make acquisitions is a part of the business, and that's legit. That's a legitimate thing. Yeah, good. All right. Whew. So it seems as though we've covered the ground. I'm really pleased to be able to do these webinars. I'm jazzed that you joined us. Thank you very much for attending. Bear in mind all those disclaimers. And Akash, thank you very much for putting this together. Thanks all of you for being here, and hopefully we'll work together at some point when the time is appropriate in the right manner, do something useful together. But even if we don't, no worries, I'm glad to be helpful. That's sort of a part of who I am. And what else is there? Well, thank you guys. I'm going to hang on here in case there are any comments before we wrap or questions, and then, give it a few more minutes in the intermediate zone. It's funny because I love public speaking, and this is a kind of a weird kind of public speaking, because I know you're there, right? I can see a couple of you on camera, but it's not as interactive. Let's face it, guys. I do prefer it when I've got a live audience, and I get more animated when I have a live audience to present to. But it's fun doing it this way anyhow, because I believe I know more than most of you do about this subject. I don't want to present stuff if I don't know what the hell I'm talking about. That's the big issue. Cool. Thank you, guys. Thank you. So we will be making a recording of this. It'll be on a blog post. It'll have a clickable index. We will email all of you to invite you to look at it when it's live. It'll be about a week probably before we get that done. And you're welcome, please use that, share it with gay abandon yeah. And the SPAC subject, we have a webinar on that. Our SPAC matchmaker service goes live any day now, but I'm going to say next week, because I'm sure there'll be things I want to tweak on it when it first hits the ground. But and next week, then that'll be fun. And if you want to engage in that, just email us and we'll send you an email inviting you to it. It's dead simple to use, not like it's rocket science. It won't be hard to find on the website either, for obvious reasons. But I'm looking forward to that because I found it virtually impossible to match a SPAC with a target and to match a target with a SPAC. You know, I went out looking, and that was the reason why we did a quick test email to some of our CEOs in our list and got an amazingly responsive result, positive result to that. So we're putting it up on the platform for that reason. But I look, when you use it, if you use it, please give me feedback. You know, I always want to know if we can do a better job in any way, shape or form. I'd like to know how it would be. There's a question there. Let me get to that. If we have a business that was about 2 years old and then slammed by COVID, would it make sense to restart with a new name, deduct 2 years of audits? Well, it can be. Yes, it can be. This actually reminds me of something I wanted to say, which is really important. If there are blemishes in your company's history, let's say, for example, we have an example of this where a company and some investors in a company, the company was being mismanaged, possibly worse than that, but at least mismanaged. And so these investors decided to buy the company. They bought the company for an attractive price because it was failing. They're the new owners, right? Then we've been working with them since then. What I would, in retrospect, the mistake made was going live in an online raise for any company. What do people do who are skeptics? They look online at the history of the company, right? That's a smart thing to do. Well, when you look online at a company that has a blemished track record, that you find the blemishes. You find that stuff, obviously, and people don't assume that it's a new management team. They don't assume that it's all being addressed and now it's a clean slate because there's no way for them to know that, right? So the smart move is if you take over a company with a blemished history, change the name, change the product name, change the company name, as long as it's genuinely substantially different. If you just, you know, I'm not suggesting doing that when you know, in the case that it's a flaky company and it's just moving forward, that's of course not what I'm saying. But in the event that you do what this company example I'm giving you did, then what we don't want, what really kills online is when there's negative stuff out there, right? Absolutely kills it dead. Makes sense, doesn't it? You know, we're in a public forum. Everything is out there for everyone to see. Let's make sure that it represents reality. Yeah, that's an important thing to do. That's one of the great things about online crowd investing, frankly, is there was all this paranoia back in 2012 when the regulations were, or rather the laws were passed before the regulations, about how there'll be all this corruption. It's so hard to have corruption online because everything's transparent. You're looking at people's LinkedIn profiles, you know, you're searching them, finding out about their history. It's all so easy to do, isn't it? Right? It makes it so much more honest and transparent, which is a cool thing. Yeah, or disclose blemishes and moves made to fix them. Yeah, that's cool too. It's harder, frankly, doing that because people don't read everything, right? The attention span of people when they arrive is really short. That's sort of a thing these days, isn't it? You've got like 10 seconds to get them, to convince them to stick around initially. But the point is the same, which is, yes, you could do it via disclosure too, except you got to then trust that they'll read the disclosure. It has to be really, really prominent for that to happen, for that to work. Okay, cool. Let's move to close. Again, I really appreciate you all being here. Thank you, and I hope that this was useful for you, and had a lot of fun. So have a great day. We'll be in touch, I'm sure, one way or the other. And thanks again, Akos. Cheers. Bye bye.